Right, thanks. We, I think, have made some significant progress in rebalancing the portfolio. We've been trying to upweight our retail exposure, which today is sitting at around 54%. If you include our stakes in some listed funds, it's about 56.5%. That's a figure we'd like to see moving towards 60% plus going forward. Now, in this set of results, we've spoken quite a bit about the deal pipeline that we have, as well as our intentions with regards to Synergy, which is a retail-focused fund. Now, if we start contemplating what that might look like going forward, if we were to take the Synergy portfolio of 2.4 billion plus approximately 900 million of other retail assets that we currently have under negotiation, the retail portfolio would then start having around 9 billion worth of assets, and that would be about 65-66% of the portfolio. So that, I think, is really making significant progress towards the overall rebalancing of the portfolio. But there's been other work that's been taking place as well, and that's been to try and increase the average asset size in the portfolio. And if you look at it today, the top 75% by value of the Vukile portfolio, in other words, the top approximately 7.8 billion rands worth of our assets, is made up of only 30 assets with an average asset size of around 260 million. We then have our balance of the portfolio, also of around 2.5 billion. That's made up of 40 assets with a value of around 60 odd million. So you can see how we've made very significant progress in rebalancing the portfolio by not only getting it more retail dominant, but also focusing on fewer larger assets. And then we have some yield kickers coming through in some of the smaller assets that gives us an overall blended, what we believe, low risk adjusted profile on the portfolio overall. Sure, I think the issue is not so much around bulking up for the sake of it. It's around making sure we find the right deals that are always accretive to the portfolio. And by accretive, it's not only in terms of being yield accretive, although most of the deals that we're doing are in fact yield accretive, but around saying, are we buying the right assets that are strategically aligned with our vision overall, that improve the quality of the portfolio. So I think one's got to be very selective in looking for the opportunities. We have been able to build a very healthy pipeline. What we've presented at the moment is what really is quite far down the track in terms of being able to close those deals. In addition to that, we do have some other opportunities that we're currently looking at. So I wouldn't characterize the market as being as there being a flood of opportunities to look at, but I think selectively there are opportunities, and if you're able to find them and close them, you can certainly increase your exposure to retail overall. We don't tend to have a specific geographic strategy in terms of what we're looking at. Our strategy is more geared towards the target market that we're looking to appeal to, and that is more the mid to lower income consumer. We really are very passionate about that sector of the market. We feel that is where the growth is going to come from in the economy. So notwithstanding that you might find the consumer under some pressure at the moment, if one looks historically through the cycle, retail has always been the most defensive asset class, and we think that that will continue to be the case going forward. We really are a consumption-driven economy, and we believe that there is so much change taking place in the work environment at the lower income space that is really where the best demographic profile is for us to have a look at. So really we throw our net far and wide. We'll look at really all opportunities in terms of geography. The key issue is, are they centres that are of a decent size, and generally there we're looking at properties of well north of 100 million rand as assets. Is there a large national tenant component of, let's say, at least 80% in the centre? And what is the demographic picture of the market that it's serving? Is it dominant in its area? Is it a convenience centre? So it really becomes more of a microeconomic discussion in terms of the fundamentals of that property that we then evaluate to decide whether to proceed or not. So Synergy is a fund that we believe would fit exceptionally well within the Vukile portfolio. Vukile, as we mentioned, is dominant in our portfolio in terms of lower income retail. Synergy has a portfolio of 15 assets worth around 2.4 billion. They're all retail assets and all focused on our target market. And we've long held the belief that that portfolio would be best suited to being incorporated into Vukile. We have the skill set and the capacity to take on that portfolio at no additional cost. So we have a very experienced team of asset managers who specialize in low-income retail. They can absorb those 15 assets seamlessly and without having to go employ any more people to manage them. The progress is as follows. We own now 40% of the company. We recently increased our stake from 34% up to 40%, and in doing so triggered a mandatory offer to all unit holders having breached the 35%. We're offering to buy the Synergy units at a swap ratio of 2.67 on the B units and 1.65 on the A units. The circular will be posted to shareholders within the next week to 10 days, and then the offer will open. And when we get Competition Commission approval, which is expected in February next year, shareholders will decide whether they want to accept the offer or not. We certainly believe it is in the interests of Synergy unit holders to accept the offer. Vukile, we believe, provides much better growth prospects, a much lower risk balance sheet, and really is able to compete more effectively. Synergy are in an overgeared position in our view. They have too much of an unhedged position, and as such, we believe, expose their shareholders to significant funding and interest rate risk, and don't see what opportunities they have to grow their fund going forward. It's a highly illiquid share. So really what we are offering shareholders is an opportunity to switch out of a unit that effectively has become a closed-end fund, switch into Vukile, which has got much greater liquidity, much greater scale, which brings so many benefits in terms of cost of capital, diversification, and really ability to take the fund to a new level. And most importantly, we think the offer is very fairly priced. If you look at Synergy's share price relative to its peer group of smaller illiquid stocks, it's at a premium to those stocks, and also the swap ratio provides for an immediate capital uplift on the current pricing. So all in all, we believe that Synergy fits very well within Vukile. It's good for Vukile, it will be accretive for Vukile, and that it's also equally very good for the Synergy shareholders who are able to switch into a better, larger, more growth-orientated entity. Certainly our strategy is to be acquisitive. We believe that we have the expertise and the capacity in-house to grow our size. We really back our team to be able to deliver on that. Whether we're a takeover target or not, one can never comment on that. I'm not sure what the plans are from other funds. But I think the antidote to that is always to make sure that you're delivering on your strategy, delivering on your promises to the market. And as long as you are able to show that you're adding value and delivering value to unit holders, the argument for somebody to take you over becomes quite a difficult one to put forward to the market. So we really are working with humility. We understand that's a threat that every fund is always under, but we focus on delivery, making sure that we can grow our fund, add value, and we'll be doing so on the front foot, looking for opportunities to grow and seeing whether there are other funds that may fit well into our portfolio. We've delivered 7.8% growth in distribution for the first half. The guidance we're giving the market is that we think growth for the full year will be in the range of 7.5% to 8%. Right, thank you very much, and I appreciate the opportunity of sharing our results and some ideas on our prospects and plans going forward.